In the crypto world, mining plays an essential role in ensuring the security and reliability of blockchain data. But if it worth the effort, given the financial aspects of the process, let's take a closer look at the economics of mining and understand where and how you can benefit. To run a miner, we need the following. First, hardware. Crypto mining requires specialized hardware, which can be pretty expensive. Electricity. Crypto mining requires a significant amount of electricity, professional cooling and room. Mining hardware generates a lot of heat, requiring an efficient cooling system. In addition, the hardware itself must be located in a suitable space. Support and maintenance. Mining hardware requires constant support and maintenance to ensure maximum efficiency and sustainability. Internet. Miners must be also connected to the internet 24/7 to keep the network running and receive new mining blocks. And the last one, software and other operational costs. In addition to above-mentioned costs, further investments may be required for expenses such as software licenses, staff training, and others. Well, let's go to the actual numbers. We'll use the data from 1st of June of 2023 at the current values. One of the most popular miners on the market, Avalon 2046, with 93 terahash of mining power that consumes 3.42 kilowatt of electricity. The price of Bitcoin is 27,000 and the mining reward is like this one. The electricity cost is 15 cents per kilowatt. That is, earning $6 in a day, you spend at least 20 on electricity for mining. Even if you can find electricity at the industrial price of 7 cents per kilowatt, each miner will only bring you 1 cent daily. On top of that, you need to spend energy of its cooling, internet, maintenance, software, and spare parts. That certainly won't bring in even 1 cent per day. Don't forget that the hardware has to be compensated for, and you have to earn something at the end of the day. Does that sound complicated and unprofitable? Most definitely. But that doesn't mean it's impossible to make money on mining. Big players are becoming increasingly important in mining. Large-scale data centers with access to cheap electricity, which they buy at industrial rates and in large amounts, providing them with significant discounts. It is important to understand that such large operation can leverage the economies of scale. This means that when you operate a large amount of mining hardware, your total operation costs, for example, cooling, maintenance, repairs, or software, are spread across many devices. This significantly reduces the cost of operation each individual unit. Large data centers are also often located in regions with cold climates or cheap electricity, which helps reduce cooling or energy costs. For example, some data centers are located in Iceland or Russia, where the cold climate and cheap energy helps minimize these costs. Of course, such data centers offer hosting services, and you can place your hardware there at a price that allows you to mine profitability. But often only a large number of units are accepted for hosting, started with at least a few dozen. And that means tens of thousands of dollars just to buy hardware, and you still need to deliver it to the mining farm and go through customs. As I said before, farms are often located in remote part of the world. Each step involves additional costs, which may be rather significant. Also, these procedures can take a long time. It may take several months from the time you pay for the hardware to the time you get your first mining reward. But can't most of us get into the mining business without a large investment of money or a time? Cloud mining is an interesting alternative to traditional crypto mining. Instead of buying and operating their own mining hardware, users conclude a contract with the cloud mining companies that provide the mining capacity to their large-scale mining farm, which I mentioned earlier. One of the critical advantages of cloud mining is that users don't need to make a significant initial investment in mining hardware. This means you can start mining cryptocurrency much faster because you don't have to wait for shipping or deal with the customs clearance of your hardware. You also don't have to maintain or service the hardware, which can be complicated and technically demanding. In the case of cloud mining, you can buy a contract that provides you with a certain amount of mining power for a fixed period. That could be a contract for a 500 terahash of mining power for 1 year. In this case, you also pay for electricity consumed during the contract period. It seems very convenient, but this method of mining also has these disadvantages, which can be fatal. One of the main risks is the issue of reliability and trust in the cloud mining provider. There's a lot of fraudulent schemes and scam projects in the crypto industry, so you need to be very careful when you're choosing a project. Another difficulty is posed by transparency. Unlike traditional mining, where you control the hardware and you can observe the process in real time, cloud mining usually requires relying on the information supplied by the provider. This can create difficulties in determining the actual profitability and efficiency of mining. It's also worth remembering that cloud mining contracts usually involve payments in advance for an extended period, and your profit will depend on the cryptocurrency's future price and mining difficulty. If the price of the cryptocurrency drops or the difficulty of mining increases, it can lead to the electricity costs that you must pay over the entire contract exceeding your income. This means that not only will you not earn, but you will be paying extra from your pocket on top of your obligations. During the fall of BTC in the fall of 2022, for example, many cloud miners users encountered a similar problem. The value of the mining rewards was lower than the cost of the electricity. We've looked at 3 types of mining: home mining, bitfarm hosting, and cloud mining, and we found pitfalls in each that make mining quite risky and, in some cases, drive unexpected costs for higher than possible profits. Is there a solution? Let's see.